Hi everybody, welcome back to the exam number 2 study guides. In this video, we're going to create a statement of cash flows for Sometimes Inc. Please make sure that you download and print the Sometimes Inc. information, the data sheet. Remember that to prepare a statement of cash flows, you need 4 pieces of information. You need last year's balance sheet. That's right here. You need the current year's balance sheet. That's right here. I have already subtracted the 2 columns to get you the change in balance sheet accounts. You also need the income statement for the current year, and you need additional pieces of information. We're going to prepare this statement of cash flows using the indirect method. Now, I posted a number of lecture videos in the instructor lecture videos for chapter 4. So you should be pretty familiar with how to prepare a statement of cash flows, and we're going to do this fairly quickly because it is just a review study guide. On the second tab of this Excel spreadsheet, I have given you the lined paper that you need to prepare the statement of cash flows. So I want you to pause the video, put in your 3-line heading on the lined paper, and then prepare your cash flows from operating activities. When you finish your cash flows from operating activities, start the video again to check your work. So net cash flows from operating activities is $151,410, calculated as follows. Net income from the income statement was $99,510. Then we have to adjust for non-cash items. And for Sometimes Inc., we have 2 non-cash items. We have depreciation expense of $58,600, and we also have gain on sale of equipment. That's not $2,000 of cash coming in the door. That is the gain on sale of equipment that doesn't even belong in the operating section. So much less not being cash received, it is the gain on sale of equipment would not be part of the operating section anyway, because they're not in the business of selling equipment. They're in the business of doing something else. So we have 2 non-cash items that we need to take care of. So adjust for non-cash effects, add back the depreciation expense, and deduct the gain. Then we need to take into consideration the changes in our current assets and current liabilities. In this textbook, they call this little section here, changes in operating assets and liabilities. We had an increase in accounts receivable of $14,000. Accounts receivable increased $14,000. And if you'll remember from my lecture videos and from your experience in preparing cash flows in Accounting 301, an increase in a current asset needs to be deducted from net income in arriving at cash flows. A decrease in a current asset needs to be added back to net income. So you should have increase in accounts receivable, bracket $14,000, decrease in inventory, add back $22,700, decrease in prepaid expenses, add back $1,000. Then in the liability section, It's a direct impact on net income. If a current liability decreased, then decrease your net income. If a current liability increased, then increase your net income. So in the just as a reminder and a restatement, in the current asset section, it has the opposite. The change has an opposite effect on net income. If a current asset increased, then do the opposite. Subtract it or decrease net income. If a current asset decreased, then do the opposite and add it to net income. But in the current liability section, there is a direct effect on net income. If a current liability decreased, then subtract it from net income. If a current liability increased, then add it back to net income. All of our current liabilities decreased. So we're going to subtract $5,000, $9,000, and $400 from net income in arriving at cash flows from operating expenses. And decrease in accounts payable, subtract $5,000. Decrease in wages payable, subtract $9,000. Decrease in income taxes payable, subtract $400 to calculate, then add up all your pluses and minuses to calculate net cash flows from operating activities, $151,410. So if you didn't get all these numbers right, go ahead and fix your spreadsheet before we go on. And once you have the spreadsheet correct, then prepare the cash flows from investing activities section. So pause the video while you prepare the cash flows from investing activities section of the statement of cash flows for Sometimes Inc. Then start the video again to check your work. As I mentioned in our lecture videos for statements of cash flows, the investing activities will include changes in long-term assets that arose because of the receipt or the payment of cash. Long-term assets, which is the equipment, increased by $9,000. But we don't just automatically pick up that $9,000. We have to find out if that is cash spent to acquire equipment. There might be several transactions that caused a $9,000 increase in equipment. So let's take a look at the other information. And here's some very important pieces of information. We'll skip number A for now, but number B says new equipment was purchased for $57,600 cash. We are showing cash paid for equipment in the investing section. So we are going to say purchase of equipment, $57,600. And then we received $10,000 cash for the sale of equipment that had cost us $48,600 and had yielded a gain of $2,000. Just for your information, that's where this $2,000 gain came from. But the cash that's involved in that is we received $10,000 cash for equipment that cost us $48,600, and the net book value of the equipment then would be the cost minus accumulated depreciation. We really don't need all those numbers, and we don't need the gain number. All we need to know is how much cash we receive for selling equipment, and that's $10,000. We can ignore all of this information. So in the investing section, you would have purchase of equipment, $57,600 in brackets because we spent that money, and sale of equipment, $10,000 positive because we received that money. So net cash flows from investing activities is a decrease in cash, so it's in brackets, $47,600. $57,600 reduced by $10,000. So now you need to pause the video while you prepare the cash flows from financing activities section. Then start the video again to check your work. In the financing activities section of the statement of cash flows, we need to report cash paid or received in connection with long-term debt or long-term financing, and we need to report cash paid or received in connection with the equity of the company. Long-term notes payable decreased by $30,000, but you don't just pick up that $30,000 and say that's the amount of cash that was paid, because that might not be the amount of cash actually paid. What you need to do is look at the other transactions. And it says that the company paid $30,000 on its long-term note payable. That sounds like a use of cash in the financing section of $30,000. Let's see if there's anything else that applies to the financing section. Again, we're looking for changes in long-term liabilities that resulted from a cash transaction and changes in equity that resulted from a cash transaction. And it looks like common stock changed by $60,000. Let's see if we can find out whether we received $60,000 cash for issuing common stock. It's $5 par value stock, and we issued 12,000 shares at par. So 12,000 times $5 per share, the full $60,000 was received in cash. So we have cash received from issuing common stock, $60,000. And I've given you the number. You could calculate it, but I've given you the number. The company paid dividends of $90,310. That's affects equity. So we've got 3 items that need to be shown in the financing activities section. Payments on long-term note payable, $30,000 reduction in cash. Issuance of common stock, $60,000 increase in cash. And dividends paid to shareholders, $90,310 deduction or reduction in cash. So net cash flows from financing activities is the net of these 3 numbers, $60,310. Bracket, negative. More cash was paid out in financing activities than was received. Okay, go ahead and finish up the statement of cash flows and then start the video again to check your work. So the next line on a statement of cash flows is net increase or decrease in cash. For Sometimes Inc., there was a net increase in cash because more cash came into the company than was paid out of the company. So plus, minus, minus, it equals a net increase in cash of $43,500. Then we need to put in the cash balance as of the first day of this fiscal period. This is a cash flow statement for the year ended December 31st, 20X2. The first day of that accounting period is January 1, 20X2. So cash balance January 1, 20X2, and you can find that number on the balance sheet. $44,000. Last year's ending balance of cash is this year's beginning balance of cash. Add those increase in cash to the beginning cash balance, and you've calculated cash balance at the end of the year, December 31st, 20x2 of $87,500. Then compare that number with your balance sheet, $87,500. It's the same, so there's probably no addition or subtraction errors in your cash flow statement. Well, that's all for this study guide. See you next time.